Good day everyone, David Paul speaking. Just a very short video to maybe help explain some of the concepts that I've written about in the UK essay, which you should be getting on Saturday the 12th of September. I'm in fact recording this, and I've written the essay on Wednesday the 9th of September to meet the VectorVest deadline. As you probably all know, there's a great deal of red on the front page of VectorVest UK and VectorVest USA as tech stocks lead the march south. So on VectorVest UK, the color guard and the traffic light says it all. VectorVest does not advocate buying stocks at this time. So I'm going to do an example of a buy in a few seconds. It's to illustrate what I've written about in the essay, which is position sizing. As we'll see in this chart, that's the VectorVest composite of the UK, and at the moment the primary wave is down. There's a red light in the color guard. There's a black star in that red light telling us that the price is falling day over day, week over week, and the momentum is also strong to the downside. As you can see from that chart, the DEW, the medium term market timing system, is down, and it's also turned down in the US. The underlying trend is still up, and we're still in a confirmed up situation in both countries. So the short to medium term systems are down, and VectorVest does not recommend buying stocks at this time. This may have changed, folks. In fact, it will have changed either for the better or for the worse by the time you get this on Saturday morning. And of course, I'll go through all the trends next Monday afternoon again in some detail at our Q&A session. But let's move to a subject that's very close to my heart, which is position sizing. I've been called into many institutions over the years, and those guys are making money and they're giving it all back again. And these are chaps trading with huge amounts of cash, and invariably when I get there, I know within 5 minutes what's wrong, and that's that they haven't got any position sizing at all. Position sizing is incredibly important. It's not that sexy. It's certainly not nearly as stimulating as finding great shares and finding great entry points to great shares, but it will keep you alive. And I've written about that in the essay, and I hope you will take a second or two to read that. So I'm going to make an assumption, folks, that you've got £50,000 in your account. At VectorVest and right across the industry, we believe that you should use a 1% risk model, and that simply means that you should lose no more than 1% of your account in any one single trade. Now, people are going to say, what about the spread? What about brokerage? Guys, if it's 1.5%, it's not the end of the world. Okay, so don't get your abacus out. But you do not want to lose 25% of your account in any one trade, which I find over and over and over again. So 1% is £500. If it was 600, it wouldn't be the end of the world. So 1% is £500. The maximum loss should be around £500 on this account. Nobody knows what's going to happen next on a single trade, folks. If you're right 75%, you're wrong 25% of the time. On the next trade, you don't know whether it's one of the 75 or one of the 25. That's one of the great realities that we all need to get our mind around. So in the great book Market Wizards, one of the gurus there, a guy called Ed Sequoia, who's got sort of real mystical status in the trading community, he says that anybody who risks any more than 2% on any one trade is a gunslinger. Okay, so I've chosen BH Macro, and BH Macro is a hedge fund, or a trust of a hedge fund, and it does very well in bad times. So as you can see, the chart looking quite good, breaking up. Earnings per share has been pushed up, and it's significantly undervalued. I'm not suggesting that you buy it for a second. Wait for the color guard to come right, but I'm going to use it as an example. Now I've just stripped off the earnings per share. I've stripped off the valuation to give us a closer look at the price action and the VectorVest stop, and I'm going to simply assume that I'm going to buy it at the open today, which should be around £36, and I'm going to use the VectorVest stop loss at £33. Okay, for this example. Now, that means that the risk per single share purchased is simply 36 minus 33, £3. We are assuming that if this share gets us in at 36 and it falls to 33, that we're simply going to get out. So the maximum risk per single share bought is £3. Now, I want to let N equal the number of shares to be bought. Now, this little equation, which is quite trivial, was taught to me by my very first mentor, a guy called Cedric. He's long since dead. And the number of shares that we buy times the risk on any one share must equal 1% of our account size. And I've applied that on every trade I've ever done since 1982. Whether it's a 5-minute chart of the pound against the dollar or a 30-minute chart of the Dow, exactly the same equation to work out how much to buy, so that if the darn thing falls apart, I risk and lose 1% of my account size. So if we just do a simple bit of algebra, the number of shares that we buy is now 1% of our account size divided by the risk per share. Simple as that. And that means in my very simple example that the number of shares we buy would be £500, which is 1% of our account size, divided by the risk per share, which is £3. That means I would buy 166 shares. My exposure would be 166 shares that we buy at £33 each, which would be £6,000. That's the exposure, but the risk is £500. Now, it is my experience that many people, in fact, don't understand the difference between the risk and the total exposure. The risk, remember, is the amount of cash that you will lose should the share drop from the entry point to the stop loss. Whereas the exposure is the total amount that it cost you to buy into the position. Now, I found that very simple little rule helps me. Now, the stop loss on this 36 is about £3. That's slightly less than 10%. Sometimes the stop loss is wide, folks, especially if you're buying into a share that's run a little bit. And that means if the risk per share is high, that you simply buy less shares. So I hope that you found that useful. And we'll talk about it and answer any questions about it at the Q&A on Monday the 14th. It's very simple indeed. Please reread the essay. Most people, institutional traders and retail traders, in fact, burn out because of position sizing errors, where they're actually trading far, far too big for their account size. As soon as they get a bad one, then that can knock them 20%. And you've got to say to yourself, what will the quality of my decisions be like if I've just burnt 20% of my account? And invariably, the emotion that takes over is, how do I get my money back? And invariably that leads to doubling up and trebling up to try and get your money back, and that's a very slippery path indeed. Thank you very much. I'll see you all on Monday.